Is an adjustable rate mortgage right for you? Let's talk about it. Hi everyone, my name's Josh, the Florida Mortgage Dude, powered by American Home Mortgage. A question I'm getting a lot is, should I get an adjustable rate mortgage? And that question is only able to be answered by the borrower. It's very dependent on what the borrower intends to do with the property and what that particular scenario is to see if an adjustable rate mortgage is the right option for you. So an adjustable rate mortgage is a loan that has a variable interest rate after a fixed amount of time. So the most common adjustable rate mortgage we look at is a 5-1 ARM. So you have a 5-year fixed rate period, and then you have the rate would adjust once a year after that. Another option could be like a 5-6 ARM. So a 5-6 ARM is, again, you have the 5-year fixed rate period, and then the rate would adjust every 6 months. So another thing to take into consideration when you're looking at adjustable rate mortgages is the caps. So one of the most common ones is a 225, and the three numbers basically outline how much the rate can adjust over the life of the loan. So the first number would be how much the rate can adjust at the first adjustment. The second number could be how much the rate could adjust in subsequent adjustments. And the last number is how much the rate can adjust over the life of the loan. So 225 would be 2% at the first adjustment, 2% at the subsequent adjustments, and then it cannot adjust more than 5% over the life of the loan. So when we're looking at adjustable rate mortgages, we also have to take into consideration like how long the borrower is going to be in the property. So if they only intend to be in the property for 3, 4, maybe even 5 years, an adjustable rate mortgage might be a great option for them. Or if they actually intend on hanging on to the property to do renovations, or if it's just a temporary living situation because they're going to have, a major life change or job. Again, it really is heavily dependent on the borrower. Another thing you want to keep in mind when you're looking at these adjustable rate mortgages is they could either be QM or non-QM loans. So what that means is if you're doing like a USDA, VA, FHA, conventional loan, those have to be qualified mortgages for them to be able to be underwritten. A qualified mortgage is essentially the federal government has put in place guidelines that lenders have to follow to meet the qualified mortgage criteria so that the loan can be securitized and sold on the secondary market. Now, if you're doing a Fannie Mae or Freddie Mac adjustable rate mortgage, and it is a qualified mortgage, which if you're doing a Fannie Mae and Freddie Mac loan, it is a qualified mortgage, then you will not have prepayment penalties. However, if you're doing like a bank statement loan or like an asset depletion program, or maybe like a non-QM loan, then you will have to take into consideration what your prepayment penalties will be. Now, this is going to vary lender by lender, case by case. Lenders can put in place any prepayment penalties they want if they are allowed on that particular program. So another thing I want to do is hop over on mortgagenewsdaily.com. So this website is something that I reference a lot. I look at this almost every single day. It gives me updates on the market, on what's going on with interest rates, and it also gives me live current interest rates. So if we hop over here to the mortgage rates tab, we're going to have a quick drop down. So you'll see here, this drop down just has a 30-year fixed at 5.4%. So that's our national average. And if we click on current mortgage rates, it's going to bring us to not only the 30-year fixed, but it's also going to show us 15 30-year FHA, 30-year jumbo, and 5-1 ARM. So if you look here, we have a 30-year fixed rate at 5.4%, and then we have a 5-1 ARM. The national average right now is 4.6%. So not quite a full percentage point difference, but it is a difference. And if you also look, there's another number right under this. So this says 0.4 points. It might be kind of hard to see. And this one says 1 point. That is the cost, the national average cost to buy those interest rates right now. The way you calculate a point is you multiply the loan amount by whatever the point is. So if you have 0.4 points, you multiply the loan amount by 0.4%. And that's going to give you what that cost would be. So this one's really easy to calculate. A 5-1 ARM right now, if it's a $250,000 loan amount, we could actually change the loan amount right here. That rate is going to cost you $2,500 on top of your closing costs. Now, if we do a 0.4% to purchase a 5.4% interest rate on a 30-year fix, that's gonna be about $1,000, you know, just doing rough math in my head. So we can actually change our loan amount right here. So let's put in a $300,000 loan amount, which is, you know, typically what we see in our office, and just take a look at what it does to our mortgage payments. So your 30-year fixed rate, 5.4%, is gonna be a $1,685 a month principal and interest payment. So it's not including property taxes or homeowner's insurance. And your 5/1 ARM is gonna be $1,538. So that's roughly $150 a month savings. So now if we calculate how much more the 5/1 ARM rate is gonna cost us, we would need to figure out, okay, what is the cost of the 5.4% rate? So if that's 0.4%, that's $1,200. Then the cost of the ARM, the 4.6% rate, is $3,000. So that's gonna be $1,800, and your savings is $150 a month. So if we divide 1,800 by 150, that's gonna give us 12 months that it would take to break even, and then you'd be in the green for buying the rate down. So we wanna calculate like how much it costs to buy the rate, and then if you're in the property, usually for longer than the cost of the break-even period, it would make sense to buy the interest rate down. You know, if the rate costs a lot of money and the recoup period, or that period of time where you break even, is, you know, 5, 6, 7 years, it might not make sense because a lot of people don't know where they're gonna be at in the next 5 years. So in this particular scenario, if the borrower was doing some type of short-term financing, or if they were in a temporary living situation, or they wanted to you know, purchase this house because they're getting it for a deal and they were going to work on it and sell it later on down the road, a 5/1 ARM may be a good option for them. However, if the borrower wants to buy the get the 5/1 ARM and they're not really sure about what they're going to do, they can always refinance later on down the road, or sell the property to pay off the note if they don't want to deal with the adjustable rate period. So there's a lot to take into consideration when you're looking at adjustable rate mortgages. If you have any questions on adjustable rate mortgages, drop a comment below and I'll get back with you as soon as possible. If you haven't already done so, please consider subscribing to my YouTube channel, following me on Facebook or Instagram. If you're already a subscriber or a follower, I definitely appreciate your support. Thank you very much. But that's gonna do it for this video. And as always, have a great day.